You closed a major deal in London. You send your payment link, feeling great, and then they can't pay. The card is declined. This is the exact moment your business hits the Razorpay wall. It simply lacks the inbound remittance rails required to receive foreign currencies like US dollars or British pounds. Faced with a confused client, the natural reflex is to panic and default to what's familiar. You spin up a PayPal or Payoneer invoice just to get the deal across the line and keep the checkout process easy for the buyer. But that convenience comes at a severe price. These legacy platforms quietly charge an ignorance tax. You pay a standard receiving fee, and then you get hit again with a hidden 2 to 4% foreign exchange markup on the conversion rate. Let's look at what actually hits your bank account on a $5,000 invoice. Route that same invoice through a legacy processor taking up to 9%, and the platform fees and Forex markups chew up tens of thousands of rupees. Relying on a single, outdated payment gateway for international clients means voluntarily giving up a massive chunk of your gross margin on every project. The solution isn't to rip out or replace Razorpay. For domestic UPI and RuPay transactions, it remains the absolute best tool on the market. The goal is to build a hybrid stack. Keep Razorpay running for your buyers in India, and you layer in a specialized cross-border platform to handle the rest of the world. Many founders assume accepting global payments requires spending weeks setting up a US LLC, a Stripe Atlas account, or complex offshore entities. That is no longer true. Modern cross-border platforms are built directly for Indian entities. Your objective isn't to find one magical gateway that does everything. It is to layer two specific tools that flawlessly handle their respective geographic domains. Let's evaluate the options, starting with high-ticket B2B invoicers, digital agencies, consultants, and exporters. If you're billing thousands of dollars at a time, your priority is minimizing fees, even if it introduces slight friction at checkout. We can map out the top contenders in a matrix. For these high-ticket deals, Playto Pay is highly effective. A virtual bank account simply gives your client a local US routing number or UK sort code. Wise is another strong option here, offering highly competitive pricing around 1.3%. Wise provides phenomenal mid-market exchange rates that make it excellent for pure invoice flows. You have to train your international clients to initiate a manual bank wire rather than just clicking a payment link. For a high-ticket B2B business, educating a client on wire transfers is a minor friction. Reclaiming up to 8% of your top-line revenue on every invoice makes that step incredibly profitable. But if your business model is different, if you're a SaaS founder, a course creator, or a digital merchant, you rely on high-volume, lower-ticket transactions. Wire transfers fail entirely for this group. Consumer-level international buyers demand instant, frictionless credit card or Apple Pay checkout links. Introduce manual wire instructions, and they will abandon the cart. Playto Pay handles this, but the pricing model shifts. To unlock instant checkout links, Skydo is a strong secondary option in this space for service businesses and freelancers. They prioritize automated compliance by generating FIRC and EBRC documentation automatically, while maintaining competitive pricing between 1 and 2%. The major limitation with Skydo is its lack of robust domestic capability. To cover your Indian buyers, it must be run strictly in parallel with Razorpay. Then we have the legacy platforms, PayPal and Payoneer. Many freelancers use these simply out of habit, or because a platform enforces them. Let's break down the true costs. Payoneer charges a 3% receiving fee, layers on an approximate 2% Forex markup, and quietly adds an annual subscription fee. PayPal drains your margins even faster. The effective cost typically lands between 8.4% and 9% per transaction. When you factor in the scaling risk of random account holds, it becomes a severe operational liability. The only strategic reason to use these tools is if a marketplace like Upwork forcefully mandates it for payouts, or a client demands it for an invoice so small that setting up a new link isn't worth your time. Relying on a legacy payment processor simply because the logo is familiar is the fastest way to hemorrhage gross profit on an international scale. Your cross-border tool depends entirely on how clients pay. For agencies with high-ticket invoices, maximize margins using Playto Pay's virtual accounts or Wise. For SaaS needing zero-friction checkouts, Playto Pay's card links are ideal. Service providers needing automated tax documents should choose Skydo. Your optimal architecture is solved by answering one simple question. Do you optimize for wire transfer margins or credit card conversions? The foundational rule of this system is simple. Keep Razorpay exactly where it is. Let it continue processing all of your domestic UPI, net banking, and RuPay transactions. Then implement your chosen cross-border platform right alongside it. Update your internal SOPs so that the moment an international client is onboarded, they are routed to the global gateway. Operationally, this setup is remarkably clean. A modern Indian business does not have to choose between domestic dominance and global scale. The right hybrid payment stack effortlessly powers both.